Welcome to the show dedicated to helping you not just survive retirement, but to have the confidence, because you're doing the work, to really lean in and rock it. When I think of retirement planning, stage one is answering the central questions. Can I retire? Am I okay? Will I run out of money? What will my retirement look like? Those central questions have to be answered first before you can get on to the business of thinking in a more expansive way about what could be possible. And they're both important. We don't just want to survive. We want to get those central questions answered, but then we want to think about how we can flourish beyond that. It doesn't get much more complicated than that. Today on the show, we are going to have Tanya Nichols from Align Financial on to do a debrief on Laura and Nick's case studies that we did in January. Tanya listened to them all and watched the replays. We're going to talk about how they were similar, how they were different, and some lessons related to them. So we're going to do that. And then in addition, we're going to answer some of your questions. Now, next week, I'm going to bring my soapbox back out and try to hit head on the question of, should I have private equity in my retirement portfolio? There's been a best-selling book arguing that you should have private equity investments in your portfolio. Had a question from a listener where they're being recommended to have private equity. So I want to hit this one head on, and what, if any, is the role. So we're going to do that next week. But for now, let's go talk with Tanya and debrief on our Retirement Plan Live case studies. Debriefs are a great idea to do after you've gone through something, whether it's a meeting or a vacation. It's good to do a debrief just to sort of reflect back upon what's happened, because it's easy just to move on to the next thing and not really integrate any lessons or aha moments that you had. So Laura and Nick from last month's Retirement Plan Live, I encourage you to do that. Do some journaling, re-listen to them. There are things that can come out of that if you pay attention. And part of paying attention is for me to do a debrief on that. And to help me with that debrief and do it with me is, I don't have a nickname for you, Tanya Nichols, yet, but I give nicknames. Tenacious Tanya? I don't know. We're going to work on it. How are you?
Good morning, Roger. I'm good.
You listened to all of the case studies and the results show.
I did.
What were your general impressions?
I thought it was really interesting to listen to two side by side like that. And one of the things that stood out to me was the differences in the way that they enjoy their time, and how that gets reflected in spending. I really like doing the side by side.
I'm thinking I might do that again in the future because it helps to compare and contrast, which gives more clarity. Let's talk about Laura first. Laura lives towards the West Coast. What were some observations on Laura in terms of her lifestyle and her plan?
Well, I second your observations in the talk that her spending overall was lower than I would have expected for someone who lives in that area. But what also stood out to me was, she was pretty confident in her numbers. And I think that goes to increasing confidence overall in retirement. So, anytime we're doing these things, you're listening to Nick and Laura talk about their spending, that's the number one lever. And so to hear Laura, kind of push back and say, hey, yeah, no, these are my numbers. I know I can do this. I go to the beach for fun, not the casino. So I thought that was one of the things that stood out to me. Yes, her spending was lower, but she was really confident in it, which made her plan really work.
I felt like I poked around that a lot because I was like, really? Come on, really? And I'm sure listeners, with the last time we had somebody on that really had a lower than average, whatever that means, spending number, got a lot of feedback of not believing it and saying that's really not possible, which I think is interesting. One, it's a good question because even look at my spending, I'm like, really? But it's also an interesting reflection on where my money goes or where our money goes. Because she literally, I asked her, like, she cycles and she has a really nice bicycle. I think she has really nice quality equipment. So it's not like she's frugal in a negative sense. It's just when she has her things, they're tools to go out into the world, not tools themselves. I love to upgrade bikes. That's probably an unhealthy way of thinking about it, right? What risks come with having a lifestyle that your plan is based off of that is so low?
Well, like you hit on, I mean, the risk that you don't do the thing, you don't do as much as you could. And you look back someday and you think, wow, well, you have this huge wealth surplus at the end. So I think her numbers were like 99%, if I remember correctly.
They were pretty
And
good.
when and when I see those types of high numbers, it usually means the probability of a pretty significant wealth surplus is high. And especially if legacy isn't a critical factor, I mean, that's what stands out to me is, well, how else do you want to use your funds earlier in order to not let somebody else decide how to spend your money?
And the dance between that, or the tension between that and sort of the other extreme I think of, is when your numbers are so low, there aren't as many buffers of spending that can be redirected, right? If I go out to eat a lot and that's in my base great life, if I have rocky times, I need somebody to come do the yard because I can't or whatever, I don't have discretionary spending within that budget to redirect if life happens because it's so lean to begin with. But there's a natural tension between what you talked about. Hey, I'm probably going to have a lot of money if everything goes well, and being mindful of your expenses. Because if we spend more today, you'll have less and you might need it later. And that's always the tension that we're trying to resolve.
And one of the things I noticed, tell me what you thought about how her date or the importance of the date that she retired kind of changed once she knew it was possible. Do you find that? Do you find that a lot with clients? Because I know I do.
Oh, yeah. Yeah. You mean when she realized it could be her birthday?
Mm-hmm.
And what is that? Why is it that we're so certain, or we focus on a date, but then we know it's real. Also, well, wait a second here. Wait a second. Maybe let me rethink this. Why is that, you think?
I don't know. Maybe, well, it's on your terms. So now you're dictating the time, or I don't know, just because you don't have to, or now because you're like, oh my gosh, wow, now I can. Now what do I do? So maybe it's not real until you get that, for some folks anyways, until you get those numbers solidified.
Well, you end up pursuing something, and then as soon as you realize, oh, I can do that, then that's the first time, or you start to really, do I really want it?
Oh yeah, like you caught you hit it, you hit the goal, and then all of a sudden you're like, wait a second, is that the right goal?
Do I really want this?
Yes. Yep. I like it.
And if we're achievement oriented, it's the pursuit that is, it just feeds on itself. I think that can happen with us. So I definitely experience in my practice, people, once they realize they can achieve something, they do pause and really evaluate. Then they start to, what does that mean? I'm going to have to change my day. I'm not going to have income. Then they start to grapple with the reality of it, I guess, right? How have you how have you seen people navigate that in your practice?
I just really always encourage them that it's in their court to keep imagining and thinking about what a day in the life of their future self looks like. And I think sometimes it just takes longer to move on from the identity of work, which you've talked a lot about on the show. So once you realize the financials are there, I think it's really, continuing to encourage them that the confidence is there on the financials. So then it's a matter of, okay, well, now start designing your life.
Well, here's a planner question. When you have someone and you're telling them to imagine their future self not working, and that freaks them out because because of the state of the country and the world right now, blah, blah, blah. And that freaks them out. If you discern that really it's the fear of having to go on that journey, not that they don't want to retire. You have the judgment. Okay, yeah, they really want to retire. You've known them long enough. But when they hesitate, it's the fear of the unknown in the journey. How do you decide how hard to push them? Because you know that they really do. They're just a little afraid, right? Same thing with kids. You got kids. How do you do that?
Well, it depends on the day, I suppose. I think my style with clients is such that I want to empower them. And I take the position that I don't know what their best life looks like, but they do, and they'll figure it out. And so I don't know that I push, I might be contradicting myself here. I definitely push my kids, but when it comes to clients, I don't pick their goal. I really want to encourage them. I mean, there's some, the die with zero concept there, and there's some that really are comfortable with the idea that they might run out someday. And then there are others who would think that's an utter failure of their plan. And so I just take the position that it's not my job to pick. So I don't know that I push super hard, but I do provide a lot of data to help them increase confidence so that when they go to make that choice, they really feel good about it.
There is
what about you?
I'm thinking about this as you're talking. I definitely don't think it's my role to make decisions for clients when it comes to especially life stuff. But I do think it is my job to know them well enough to know when to poke and challenge just because they're afraid of the unknown or they're getting in the way of themselves. And this is where having some coaching chops is really helpful in doing some reps there and some training, because a good coach never tells you what to do, but they do reflect a lot of things back at you that are very uncomfortable. Right. And so there's a dance there. There's a dance there. You and I had an interaction recently where someone said, just do it. And it was sort of off-putting because who are you to tell us what to do or not, right? Even though they were in a coaching role. So it's interesting. Anyway, any other observations with Laura before we move on to Nick, and then we'll compare them a little bit.
No, let's chat about Nick.
Okay. Nick is a whole nother animal, right? He lives in a major metropolitan area. He has a big heart for service. He is less about outdoors, go to the beach vibe, and more about interacting in urban environments. He likes to go to casinos. He likes people,
museums,
and things that cost money, or going out and his social network. Very different than Laura. What was your vibe with Nick?
Well, I liked the fact that both plans were so different. Like hers didn't need a lot of modification, but then when you worked on his, you showed just how a few different levers, like not inflating the mortgage, just changing that one little thing, and a couple others, how you can get to similar outcomes by just rethinking some of those inputs. So I thought I really liked your creativity with how to make that possible rather than just plugging it all in, hitting the button and saying, oops, sorry, can't do it. Which I think is what happens when people use tools like that sometimes. They just click a button and say, oh, it's 40%, done deal. But you can really get creative with those inputs, and you're able to show Nick a way to make this possible.
I always preach about don't try to get too precise. Right. I'm always pushing against the geeks to get too precise, but you do need to have some level of precision. And the mortgage is a really good example, right? It doesn't inflate over time. And if you got 30 years on a $2,000 a month payment, that becomes a huge number if it's inflating over and over again. And like you said, I think, Tanya, with those tools, it makes a material difference in the decisions that you make because not understanding the nuance, right? Literally, you could work 3 more years because you didn't think, oh, my mortgage doesn't inflate.
Exactly. Or hard coding the legacy. Yeah. We do the same thing here where we're typically not hard coding the legacy for the reasons that you illustrated in Nick's plan. That do you want to make a 3-year change in how long you work for some future that is like, it definitely varies. Like you don't know how that's going to turn out. So not hard coding the legacy is another one of those levers that you pulled that I think is important.
Yeah. Another lever there is if you do want to leave a certain amount of money and it's not going to be the house, or like you pointed out earlier with Laura, if you have a plan that's feasible and you make it resilient, it likely will overshoot and have more money than you need because we're not going to optimize it to the nth degree because then it's too fragile. So you likely will have an inheritance even if you don't plan for it. But if it's one of those things that's of certainty for you, it's worth exploring. Do I buy life insurance to solve for that? And that's life insurance is leverage. So you probably get that amount of money at the end for a lot less money in the premiums that you pay.
Mm-hmm.
By the way, we're talking about Nick and Laura's journey. If you haven't watched the replays, the results shows, you can find those at rogerwhitney.com under free resources. We have a list for all the past retirement plan lives. So if you didn't get a chance to catch it, or you want to revisit that, you can go back and watch them there. Anything else related to Nick? Obviously, he was dealing with a huge work crisis.
That was, a perfect example of how you can focus all you want on precision and all the little steps that you need to do. And at the end of the day, you can get a total curveball. So making sure your plan is resilient is such a key part of this. And I think, if we can open our minds to the idea that these changes are going to come, whether we like them or not, and just try to learn to be more adaptable to them, that's going to keep happening once you retire too. And I also noticed both of them were taking care of their parents.
They were.
Right?
I didn't even clue in on that in some way.
I think that's another thing to notice about the single no kids situation. One of the things, and not that married couples aren't caring for their family members, they certainly are. But I do think that becomes, I've noticed that with my clients who are single, that they end up being a primary caregiver for aging parents oftentimes for a variety of reasons.
Yeah. Before we go there, let's go back to the having to have a resilient plan. I had a little rant last week on the show that you haven't heard yet. And it's easy to forget what's most important and put the least important things first. And as you were talking about that, one metaphor or image that came to mind is me driving. I'll use Colorado because that's one of my favorite driving. Me driving to Colorado, stopping to get my horrible Big Mac, because that's like my guilty pleasure when I'm on a road trip. And I'm driving on the road, eating my Big Mac because I don't want to waste time. And there are times when you're driving, eating a Big Mac and maybe grabbing your Coke, you're probably not going to have your hands on the wheel, right? You're going to have your knee on the wheel or whatever. I'm not proud or not proud of this. It's just a fact. And it's easy to make those things the priority because you're on cruise control at 75, everything's safe. It doesn't take long, and this is sort of the point with Nick, where new administration, new priorities, all of a sudden what you thought was a safe, very secure job with the federal government, they don't have layoffs. A very secure job suddenly becomes very unsafe very quickly. And that's like, I'm driving, grabbing my Coke, and I see a deer or see something happen. I'm like, oh crap, I need to make the main thing. It's very easy to forget that. And Nick is navigating that right now, and it sounds like he's in a relatively good spot to navigate that, thankfully. But you're right about the parents. Less people to help.
Mm-hmm. Yeah, you just don't know what kind of surprises you're going to have in retirement, whether that's helping parents or a job change. But I think it's almost like looking around and there's going to be discomfort, whether that is the job change before you expected it to be, or retirement before you expected, or, like the fires in Los Angeles, or, whatever the latest crisis is. So the more we can get comfortable dealing with discomfort along the way, I think the better we'll succeed through major transitions like retirement. And you talk about this all the time. Who's this Stutz?
Oh, Phil Stutz.
Right?
Yes,
Phil Stutz. And what is it? Pain, uncertainty,
wait,
and
you're
work.
Giving me the opportunity. You will never be exonerated from pain, uncertainty, or the need to do work. You'll never get out of it. That was
a yes. And so I think that's how you approach these types of things, is that even if it says 99%, and even if there's a wealth surplus, there's a million things that are going to change along the way. So getting our mind straight about approaching those things, that's actually probably one of the most important levers to pull outside of spending when it comes to retirement.
And we'll use Laura as the example, because you mentioned that she was at 99% and how she's taking care of her mom. There's a part of us that needs to be present with them, right? That we need to be there with them because we are family. We have the connection. But there's also the opportunity of using some of that excess confidence or funding to make it easier so you can still ride your bike in her case, right?
Yes.
Where you're not just delegating this to paid providers. I mean, that would be the extreme, but there's a balance between I'm holding this flag, it's my mom, I'm sacrificing my life. There's a balance between that and just spending money so you never have to go be with her that I think we can find if you have the opportunity.
Right. Like get creative about the things you could outsource. If you feel like you really can't outsource the being together thing, maybe there are other things in your own home that you can outsource to reduce your mental load at home, for example.
Yeah.
If you feel like you really need to be at mom's or something like that.
Organized, creative decision making.
Mm-hmm.
Now let's talk about compare and contrast. Now, one thing that really stood out to me was Nick didn't have significant wealth, but he had a lot of, well, I guess they actually, at the end of the day, that was my impression, but I looked at their net worth. They were actually relatively similar. So let me rephrase. Nick had a lot more spending, but he also had a lot of social capital.
Mm-hmm.
Guaranteed payments, in his case, mostly inflation adjusted for the rest of his life. That makes life pretty easy.
It makes your spending decisions feel easier, for sure.
Yes. I've seen this many times with individuals who know they're going to have a large inheritance. They make decisions differently.
I would agree.
Not all of them. I have some that are very cognizant of, I can't include that. There's a lot of processing about they can't count on it and they want to stand on their own 2 feet. But then there's another contingent where they just make different spending decisions because they know they're going to get a lot of money. And so they're more willing to take risks with their own. I'm not saying Nick is that way, but it definitely makes it easier.
Mm-hmm. Well, and there's not, so like in Laura's case, when she had mentioned, well, with everything that's going on in the economy right now. So she felt like her decisions were more impacted by external forces because of, she's ultimately responsible for the majority of her income.
Yeah, because from her capital other than Social Security. And
exactly. Yeah.
How do you incorporate with what's going on in the world into planning and life choices?
Well, I think we have a similar approach in the fact that I don't want their dates to be dependent on these things that are outside of our control. So we really just hone in on spending and these sort of, let's call them temporary shocks to our psyche and maybe our finances, depending on if we, work for the government or, depending on what the market's doing. But, you got a long window. It's 30 years. So I had a couple people retire just before COVID. And I always joke that as people are leading up to retirement, I just let them know that they're probably going to be the cause of the next market crash or pandemic or government shutdown or whatever crisis of the day is. So I usually, I'm teasing, but sometimes that's just how it goes. And so you want to have a plan that is resilient. That means, even if there's a pandemic or a complete government shutdown or some major event, that your plan still works, or that you're prepared for the adjustments that it might take for a year or two in order to make your plan feasible.
Because ultimately, you never know what's going to happen next.
Yeah.
It's always different this time. The world always is in a state, and you do have to be aware, but can't let that dictate your life.
No.
Any other compares or contrasts with Laura and Nick?
No, I just would, I look forward to doing another side by side. I think that was a fun way to hear about their stories.
Now it's time to get to your questions. We want to help you take a little baby step on your way to rocking retirement. Our first question comes from John, who is looking to save more money. Hey, Roger, I have recently started listening to your podcast. I'm up to number 28. John, this always amazes me that we go all the way back. That must be a very common thing. That's 11 years of podcasts. I don't even know who that Roger is anymore. So let me know how those shows are. Are they any good? Anyway, I'm 73, took advantage of an early retirement offer after 36 years. They offered a very good 401k, which I took advantage of, retired in June 2014, a month before my 63rd birthday. Currently, my income is three sources: my required minimum distribution from my IRA, annuity, and Social Security, which I started at 68. My husband is 18 years younger than I am. He's still working and he has a 401k through his employer. Our combined annual income is about $140,000 a year. 2/3 of that is my income. We are doing pretty well. Our plan is for my husband to retire as early as possible, maybe in the next 2 years, so we can enjoy time with each other traveling. We don't have any children. We do have some extra income each month and started a spousal Roth IRA for my husband. My question is there a better way for this extra income to be used rather than in a spousal Roth IRA? And if so, what? Thanks for the help. That's a great question, but the word better, John, can be a little problematic because that's going to mean different things for different people. What do we mean by better? Because that's a qualitative judgment of, I don't know. It depends on what's most important to you in this season of life. So currently you have extra income. You're saving it in a spousal Roth IRA. And the question is there a better place to save that? The way to find the answer is, well, what is the purpose of this money? What is the purpose of the money? What are you trying to solve for? If we assume that you've already paid off debt, you're already living like you want to live, and there's not any better use for this money in terms of maybe living a little bit more now, or there isn't a need, whether it's charitable or otherwise, that you could apply this debt to, and this money is truly for investment or for savings, then the next question would be, what is the best way to save this? Is it best to save it because I need cash? And that's going to depend on your liquidity. If you're working to him retiring in a couple of years, do you have enough liquidity when his income goes away to fund the life for both of you between your income and the two of yours assets? So that comes from having a plan of record in place. So think of it this way. Right now, your income and his income are paying for life. So when his income goes away in a couple of years, what is the gap that's going to need to be filled by his income going away, if any? We want to know that first. And then where are you going to fill that gap from? Do you already have cash savings to fund the replacement of that gap that's going to be gone when his income is going to be gone? If you do, if you already have some clarity over the next 5 years of exactly how you're going to replace the gap once he stops working, then this money could be for investment or for consumption or for gifting or otherwise. But you want to go in the right order, John. And assuming that, okay, when his income goes away in a couple of years, we have the liquidity to replace enough of his income to cover what we want our life to look like. So this really is long-term money. Then we can talk about how best to invest it. And then when you're thinking about investing it, the next question is, what's the best tax vehicle to do that in? I think a Roth IRA is a good tax vehicle if you're able to make those contributions to start to funnel money to. But I would go through that order, and best is going to be more qualitative, but it doesn't sound like you're on a bad path right now, assuming you have some clarity that when his income goes away, exactly how you're going to cover the gap. Our next question is from Edward about diversification versus safety. Edward says, I have about $760,000 in an actively managed bond fund in my 401k, and I get about $3,200 a month in dividends. Would it be wise to turn the rest of my retirement money, which is substantial, $4.6 million, into this bond fund, which would provide me $19,580 of monthly income, probably sufficient for my monthly expenses? Or should I keep my money diversified? Currently, I'm in 60% equity, 40% bonds. I'm 62, working half-time, beginning March 2025, and married. All right. Basic math here, Edward. If you put all of your money into this bond fund, you'll get about $20,000 a month or $240,000 a year in today's dollars. And it sounds like that's more than enough to meet your needs. So essentially, maybe you won the game financially. It sounds like you did pretty well. Do you just put it all into a bond fund? And currently you have 60% equities, 40% bonds. It's going to come back to what is it you want? And the way I would recommend you approach this, Edward, to think through this in an organized way is to get a feasible plan of record of exactly what you anticipate or desire spending for your base grade life, your discretionary wants, and your wishes, your aspirational things. And when those types of spending will start and when they'll stop. I'll need a car every 4 years for this amount. I want to travel on a big trip every other year for this many sequences. I want to buy a boat in 10 years. I want to be able to do annual gifting for 10 years. Individual goals with individual amounts, when they start, when they stop, and what the sequence of the spending of those goals are. You want to map those out. If you're, how old did you say? You are 62. Let's assume for a 30-year time frame. So you have a base great life that you'll have to meet for you and your wife to have a base living that you really enjoy. And that will continue on between now and 92. And then you have discretionary spending that you want to do in certain sequences. Maybe you want some go-go spending early, some travel early, some gifting later. Think through what those might be and in what order and sequence, etc. Then look at your income sources, because you have Social Security, I'm going to assume, that will offset some of that, and that's inflation adjusted. And then you have some maybe pension or part-time work right now. How long are you going to do that? And then you have the resources that you mentioned. Do a feasibility analysis using software to determine whether you're overfunded, constrained, or underfunded. Sounds like you're overfunded for the goals, at least the way that you frame the question. Do this first before you get to the question you have. Now that you've gotten to this question, you can start to explore, if we're just focused on risk, hey, I won the game, let me just put it in bonds, not worry about it. We're not thinking about other things you could do with life. If we're just focusing from the lens of risk, now you can say, how is this feasible over 30 years if I sacrifice potential equity returns and just have the returns of bonds? Is this feasible? And software can easily show you the feasibility with different types of portfolios from grandma. I call it a grandma portfolio, basically having bonds to 100% equities. Now you can look through the lens of volatility of, hey, if I go all bonds, does it impair the long-term feasibility of the life that I said I wanted to live? And you can look through that lens. And it may. If it says that it's okay, Edward, does that mean that you do it? Not necessarily, because that lens of, hey, I can put this all in a bond fund and get $20,000 a month in income doesn't give you the entire picture. First, it doesn't give you the picture of what that income will be over time, meaning that just because the bond fund pays out $20,000 a month for the amount of money that you're talking about per month, it doesn't mean that it will always do that. If interest rates go up, then the yield or the income could go up. But if interest rates go down, the income could go down as well. So that income is not guaranteed because it's a bond fund. It has a portfolio underneath that that's constantly generating income of some sort. And the value of that portfolio is going to go up based on interest rates, defaults, and other factors. So that's not guaranteed income. It's not like buying an annuity where you know the exact dollar amount that you're going to get. So it's not going to look at it from that lens. So you got to be careful there. The second area you want to be mindful of, Edward, is that over 30 years, there's this thing called inflation. And I'm being sarcastic. You know that. So if we just assume for a second that you need $20,000 a month to live, well, inflation will increase the amount that you actually need, meaning that if it's $20,000 a month today, over 30 years, that $20,000 a month will lose value. It won't buy as much in goods. Over a 30-year span, just assuming 3%, $20,000 will only buy $824 in 30 years. In 20 years, it will only buy $11,070. So the value of that $20,000 that you're getting every month will go down just as a matter of inflation. If inflation is higher, it'll degrade the value of the dollar at higher levels. If it's lower, it'll moderate it. And bond funds are not good inflation hedges. So they're great with markets in not losing money to volatility. They're a lot less volatile than equities, but they do a horrible job in managing inflation risk. So very rarely do we say, go into grandmother's portfolio because there's inflation risk and we don't know what inflation is going to be in the future. In addition to that, there are unknown spending shocks that could come in the future. That could be the negative ones we think about. What happens if long-term care event, early onset Alzheimer's, really dramatic negative things, but also positive things can come in of spending shocks. So perhaps you don't know what your 65, 70-year-old self is going to want and might have a broader vision for what you want to do or to give. And so we want to have money working and growing to battle inflation, as well as build buffers for unknown expenses that might come up in the future, good or bad. So that's where this starts to break down a little bit. Now, there are different ways of approaching this, Edward, to have the security of income that you're talking about in terms of buying a bond fund and having consistent income. And that is potentially taking part of your assets, defining what is the base amount I need per month just to support our life as a worst case scenario, figure out how much it would cost to buy a pension to cover that amount, which would be in the form of annuity in this case, a very plain Jane annuity that is trading your money for a pension or a guaranteed income for you and your wife's life. And then the rest of the money can be invested any way you want, but you've created this constant level of income and still can have liquidity to go do other things. So it's not quite as simple as just go buy a bond fund, because there are a lot of risks to bond funds depending on the kinds of seasons that we're in. The main ones are going to be inflation risk over time. Just a couple questions today because we spent some time with Tanya. But for now, let's go set a smart sprint.
On your marks, get set.
And we're off to set a little baby step we can take in the next 7 days to not just rock retirement, but rock life. All right, in the next 7 days, I encourage you to take this little baby step. Early this year, I encouraged you to start a tax file. Remember that? Well, you have probably been getting emails and envelopes with tax documents over the last couple months. Be a good sport. And if you work with a CPA, start to organize those things and as best as you can, get them to your CPA or tax preparer as early as possible. They work under tremendous deadlines and they're going to serve you best if they have time and it's not caught up in the rush. Yes, they can file an extension. And I say this and I encourage you to do this as someone who can be a little remiss in following my own advice. Partly because I get things coming in so late. So that's your action item is you're starting to get this stuff, get that stuff organized. And if you got everything, get your taxes done or get that to your preparer. Now for the next installment of my grandfather Zygmunt Kansler's flights in a B-17 Flying Fortress over Europe in World War II. Mission number 24, August 6, 1944, ship number 274, sortie 16th. Well, hit the halfway mark now and started on the home stretch. We hit Las Valence, France. Target hit darn good. No flak or escort or enemy fighters. A very nice one today. Carried 12 500-pound bombs. Mission number 8 hours. Altitude 22,000 feet. Short and sweet. We'll continue on with the next 25 missions next week. Hope you have a wonderful week. The opinions voiced in this podcast are for general information only and not intended to provide specific advice or recommendations for any individual. All performance reference is historical and does not guarantee future results. All indices are unmanaged and cannot be invested in directly. Make sure you consult your legal, tax, or financial advisor before making any decisions.